Hello, this is Brian Cox. Today I'm going to be talking about setting stops. Last month I had discussed that I use stops to exit trades and that the value of the stops were used to define my trading risk. Today I will quickly describe one of the methods that I use to determine stop values. I primarily use stops one way, and that is to exit a position when a trade goes outside my predefined criteria. Every trade I make incorporates the use of stops or equivalents. I can limit my downside risk. The stops are based on patterns I identify in the stock charts. I move the stops upward based on the upward movement of the stock. I view the charts using candlestick style, looking for horizontal areas of support. Sometimes I need to start at lower levels and work my way up to higher values. Remember that sometimes support is not so much as a sharp line, and it's sometimes more like a crayon. Also remember that former risk will often later become support. I usually pick two levels of support down from the current position, then calculate 2 times ATR and subtract that from the selected level of support. Let's do an example. Okay, this example is NVIDIA. And you can look at this, you can sort of see some areas of support right now, but I often will draw lines on it so I can more clearly define what I'm looking at. Okay, here's the first level, first three levels. I'm again working from the bottom up. I find sometimes working on a clean chart, it's easier to do it this way. And so you can see that this is the first level, and I just took it from where I saw it gap up to. Then you can see where it sort of stalled here, then comes back and tests this. So I would call this another area of support. Then it comes through here. It was off the top of here. It stalls a little bit going here. It bounces down. So therefore this must be an area of support as well. And then let's add in two more areas of support. You can see it was a congested area here, then it broke through, came down, tested, and took off again. I call that an area of support. Ulta right here, it broke through, stalled a little bit through here and took off. I call that an area of support. And then add two more areas of support right here off the top of here, and right here where it sort of stalled and then bounced off of again. So those are where I would call my support lines. And now what we want to do is figure out where we're going to put the stop. Okay, the stop is simply a stop equals support minus 2 times ATR. ATR is the average true range. I put it on my charts right here, and it's the average true range. In this case, I use the last 14 days. What you can see here is the value. Here is 5.1 for the last 14 days. And so the formula is simply where I'm going to pick my support. Again, here's the first level of support. Here's a second level of support. Let's call that 200. And then we want to go over here 2 times 5, which will be 90, which is where I'm going to put my support. And so we're trading up here. We've got the support down, or the stop here, and there's the support. It's all kind of straightforward. And so that's about a 10% stop. But you could have picked 190 as where you feel more interested in or more comfortable. You might have called the 200 your first level and then the 190 is your second level. And if you had done that, then the stop would have been more like a 180 or about 20% percent lower than where it's trading right now. Either one is acceptable. It's up to you. But I would just pick this level of 200 as my support, and then 2 times ATR from that would be 190. Okay, and there's a series of possible follow-on presentations that I'm considering. One is how to assess risk based on where you put your level of support, how to actually move your stops up, how you track individual positions. Here's tracking portfolio positions, stock selection, and stock selection criteria. Previous presentation was actually on a 5-year portfolio performance, which has returned over 100% in the last 5 years. I hope that you enjoyed this presentation. This is Brian Cox.